Hi everyone, this is Chris. It's December the 6th, and welcome to our monthly Connect series with premium members. For those of you that are males and you celebrate Christmas, you don't have long, so you better get busy. Christmas is not too far away. Hey, just wanted to, as we always start out each webinar, we talk about that, at Kimble Charting Solutions, we're not a bull or a bear shop. We believe that being bullish or bearish is nothing more than a psychological state of mind. It's not a strategy. And so we want to talk, how we can implement strategies and keep our emotions at bay to the most possible. We all have them. I do. We're never going to get rid of them, but we'll try to minimize them, as much as that we can. Wanted to turn back the clock a month ago when we had our November webinar. It was a week before the election, and this was our opening slide. That I'd said that a week later we would know who we would have as president, and that the main theme was: are things going to stay the same, or are we going to see a big change? And how could we take advantage of the emotions through this process, and in this what we felt like could be a good change? And we were seeing, this guy down here in the lower right has several faces. We were seeing almost all of those in different asset classes a month ago. But now the election's behind us. We were really excited and looking forward to it. Not about who'd win or lose, but just that maybe it could break loose some of the stalemate with a lot of people. It seemed like, and get some movement going. And we've had some movement. And I just want to say thank you to all of you who are members. Thank you for giving us a chance, listening to some of our sometimes fingers on a chalkboard, ideas, because if we're going to be at a turning point, it's going to go against the majority of us, and a lot of times you and I, when we look in the mirror, we're part of that majority, so sometimes the trades can be hard, but we try to risk manage, those. I feel really lucky and blessed, with your membership and the type of things that have happened, this year, and especially in the last 6 weeks, we've been blessed that we've had movement, and we've gotten lucky to be on the right side of a lot of things, and especially in some of the places that have moved the most. So thank you for your kind emails and sticking with us and having hopefully a lot of fun along the way, because we are having a lot of fun, and I think there's a lot more fun to come, everybody. So today I want to kind of just go back 30 days. This is the Aaii Bulls percent of people that were bullish going into the election, and as you can see that despite the market being close to all-time highs at that time, and this print you can see in the upper right was as of October 26th, a little bit before the election from Sentiment Trader, but down here in the lower right you can see there's about 20% bulls, and when you look back over the last, this chart is roughly a decade in length, obviously this is where that type of sentiment, some lows can take place, or some rallies can take place, and so that's where I felt a little bit more comfortable when the power of the pattern was suggesting some upside movement could take place, and it was worth taking the risk that the majority didn't feel very optimistic or bullish, going forward. So it was an uncrowded trade if you were long, about a month ago, and I think that's why it's paid off for us. So one of the things I just kind of wanted to take us back on the day of the election, I said, and I want to welcome all of the new premium members that have come on board, and we also have a nice shop in California. Todd, I hope that you're on the line. I know that you are, and your team. Thanks for doing some work with us. But the day before the day of the election, I sent an email to all premium members, and I just said, hey folks, just want to make it clear, that we're long financial stocks or banks in the United States and Europe. And this was a real beta play, because if things were to pan out, we felt like this is where you could get the most bang for your buck. Also long energy, and we had been short bonds, and that was part of the reason for being long financials, because of how that was paying off. And as we said, at that time, these were not bets that the world was going to become a bug on a windshield or the sky was going to fall. These were obviously long bets for higher prices. And as we look back, this was done yesterday. These are the 9 key sectors of the S&P 500 plus the S&P 500. the performance over the last month, and I did this as of last night, and you can see that the two key leading indices were financials and energy, and you know, obviously 17% in a year is a real blessing, much less 17% in 30 days, and you can see how far these outpaced, you know, the S&P 500 during that time frame. So that's why I say it's been a good and fun month, and I think we're going to see a lot more fun things, you know, to be. But as we'll discuss at the time, you know, a month ago when we were long these positions, we were just long because the power of the pattern and the risk management said that's the way to be, plus sentiment. And so you can see how things have changed. This is the same chart that we looked at from a little bit ago. That was October the 26th, and now it's November the 30th. And you can see a swift change in bullish sentiment in just radically in a couple of weeks. And so this doesn't mean the market is at a top or any of that, but it does. You can see that more often than not, when the market is or Aaii Bulls are up close to here, the market doesn't have to be at a top, but it more often is closer to a top than it is a bargain compared to where we were just 1 month ago. So it's fun to see these emotional shifts. This plays into the power of the pattern, and I think this is what makes it a lot of fun and opportunistic for the type of work that we can share with you guys to empower you in your own decisions. So this was a number of indicators showing pessimism. As an example, at the time before the election, you can see there was very few indicators that were showing a lot of pessimism, which is bullish, and you can see where it's also changed somewhat in a large swing in a short period of time as well. So one of the things I kind of want to remind some of you on the line, I see you've been premium members for years, but I kind of want to go back through for a second, you know, Sir John Templeton's 4 stages of a bull market. And Sir John always said, you know, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. And most of you as members know that our strategy is called TBNM, which stands for tops, bottoms, and no middles. And so what we're trying to, I just want to kind of always talk about this every so often is, you know, when you see this type of a look, you know, on your coworkers, friends, relatives, yourself, society, you know, in some way, pessimism, I want you to look for that as an opportunity. And then when you see euphoria, you know, we've talked about if you had a garden of ripe tomatoes, what would you do with the tomato? Would you pick it or just let it rot on the vine? You know, we have to do some harvesting to take advantage of these things, and they take place when we see euphoria out there. So one of the things I wanted to do today was just kind of talk about how I build some of the power of the patterns. And remember, this is all about emotions with us. This chart, it doesn't matter what it is, going back 12 years, it's all about price. And you can see that it's moving in this upward slant. And so I want to show you how I build some of these channels and how we worked into a trade as an example and how it started. So what's interesting for me is if this is potentially at a high point here in the upper right, I want to start down here to see if up here has any validity. So these are emotional points, and what are we looking for, everyone? We're looking for the pessimism, and so we're going to tie a couple of pessimistic points together and create a channel line. So this is the bottom line of pessimism. Now, what we want to then do is take this line and create a parallel to it, and what if we just lay it right here, everyone? We take this line and lay it up here, or just draw another one. You can see now there's a uniform channel of emotions with pessimism down here and optimism up here. And other things that we look for are other signs of this is a sign of pessimism. And then there was a couple of signs of optimism here, and you see a dual point of resistance. And then we start looking at, do other things come into play? Here's an example at this time in this asset. The relative momentum was extremely overbought in the middle of this year. Also at the same time, this asset, if we took the top, when it was hitting the top and the bottom of these marked channels, if we would take the distance of here and add 61% for the 161 fib level, you can see that that came into play also as double resistance, and momentum was overvalued. So things were fairly cocky then, and I can just tell you the sentiment on this asset at the time in July was 85% bulls. So it seemed to be a crowded trade to me. And then you can see here are the results of what happened. This asset fell a large percentage, and I'll disclose, what this is. This is TLT, the government bond, and from this point where we entered the short under these conditions, TLT experienced one of its largest 20-week declines in history, which means we own TBF, that we got a portion of one of the largest bond moves to the downside, but we got it to the upside in a 20-week period, and we'll see how rare that move was that we were really blessed to be on board. So here's another piece of things that we look at in the background, and you can do this on your own. I encourage you to do it. This is from Stock Charts, which I believe they have a free service, and then they also have some paid subscriptions. But what I encourage you to do, and what we try to do, is look for extremes. And so they have a formula, and I doubt everyone at Stock Charts, we all know, is not the only one that can do this, but I just want to share this is where I'm doing it and how we're doing it. So we go and enter a rate of change. In other words, we're looking for 1-year returns. And as we look down here, this is 1-year returns on TLT. You can see right here that it was up almost 30% at this point. And what had happened in the past when it had such a 30% rally in just a year? It was a pretty good move for bonds. So I just kind of wanted to show this was some other pieces that we're looking at in the background, creating filters for you. We don't show all of these pieces all the time, but I just kind of want to share some of the background pieces that we look at that can help lead us to power the pattern moves. But you can see in prior times when TLT had been up 30% or more in a year, TLT was closer to a high at that time than a low. And then you can see that TLT was facing a key resistance level at that same time. Another piece of evidence of why to go against it with a tight stop, right up here at the top against resistance. So this was, we were mentioning sentiment. This is bond sentiment as of just recently, November 25th. What I wanted to share was this past summer. This is in July. This is the sentiment that I was talking about. There was 80% bond bulls, and so there was plenty of cockiness. So these are the type of things we're trying to help see and share with you and empower you to help you make trades on your own. So another piece of evidence that you can calculate on your own, it comes from Stock Charts as well. And this is, we're all familiar with 100-day moving averages, 150 and 200-day. The point isn't, that this is an exact moving average that's precise to use. This is just a measurement in time and over and under valuation. So what this formula does, everyone, is it calculates the percent above or below any asset is above its 150-day moving average, and I've also done them on 2. But what we noticed this past summer was you can see how far below, almost 25% below its moving average was, this is the 10-year yield, TNX, on the 10-year note, or the yield on the 10-year note, excuse me. And one of the things we were noticing was the double bottom potential and how oversold, or how far below its 150-day moving average it was, that it had a chance to bounce back. And right here is just a combination of an extremes and numbers plus the power of the pattern. And so we came in and went in long yields here and shorted bonds. And this had nothing to do with elections. At that time in July, I shared it a month or so ago, that the number of people thinking that the Fed would raise rates in July was 10%. So in other words, the crowded trade, it surprised people, and so the 90% were wrong that rates did go up. It's not that the Fed raised rates, but you can see that right here, this is the dramatic rate rise that we longed or shorted bonds. And so now this is what I want you to put your attention on, is right now the TNX is 32% above its 150-day moving average. So we went from somewhat of an extreme here to a rarefied extreme that has only happened one other time in history, which was back in 2013, where rates that far above their 150-day moving average. And sorry I didn't make a mark, but if you just kind of follow up here, you can see that bonds were very close to peaking out at the time. They were 30% and a little bit more above the 150-day moving average. So the take here, folks, is just a filter for us that we look for extremes on both sides, and so this is what we use to help in the trade to short bonds, but also want to just empower you now that we have some other extremes that are going on the flip side of what we saw in July of this past summer. And we're going to dig into this more, but I want to share this is another tool that you can use at stock charts, and imagine a lot of other software that's above my pay grade. Here's something from Ned Davis research that I saw on the web, and you know, this is Treasury bonds at the top, and it's not about the patterns to be. This was just what caught my attention was this was the Ned Davis research bond sentiment composite, and you'll notice that they have a line in the sand according to them that's what 62 or above is excess optimism anytime it's above this dotted line, or 38 or below to them is excess pessimism. And so I know this is a busy chart, but I think this is what intrigues me the most is, so right now the sentiment is below 38, and so they had went in and done a study that only 23% of the time, you know, is it below or oversold, but the average rally a year later, anytime it's 38 or below, from 1984 to current has been 9% a year later. So you can see that's the best time to be a buyer of bonds historically when you see this excess pessimism taking place. And then they did the same thing again, but they just compressed the time period to the last decade, and you can see that only 22% of the time, which is almost close to the historical average, has it been below the 38% level. But the returns are quite better, that the average gain a year out is 13%. So, you know, a bond player, obviously, if things would pan out, if a person would purchase a bond and make 9% total return a year from now, that's above probably historical averages, but that'd be a nice return. Obviously, if it got closer to 13, it'd even taste better. But again, sentiment is, bonds are now, this is when we shorted them this past summer. You can see where they were with Ned Davis research. I didn't see this at that time, but you can see where it is now. So another one, this is doing, as I said earlier, we could do the 100-day moving average, but this was an example. I just did the 200-day moving average, and you can see on the 10-year yield that the numbers came out very similar. But just to show you, it's a rare event. Only one other time in history have yields risen or been this far above the 200-day, you know, moving average, roughly almost 30%. And this sharp rally in yields has now, keep in mind, this is a chart that goes back to 1981, so everybody, we're looking at what, 35 years, 3.5 decades, back to Ronald Reagan time. But you'll notice this this bottom channel line, as we shared earlier, in an attempt to look for tops, we have to go the other way and look at our bottoms to try to create the channel. So it came through here and created this line. In the interest of time, I'm just going to tell you how we did this. Did your parallel, and you can see right now that the sharp rally has them pushing up against this long-term channel. Some could make the argument that it's influenced prices clear since 1980, 25 years. But the bottom line is this is a big test of resistance. So, and for historical perspectives, it has paid each time, obviously, to short yields or long bonds when it's up against this channel. And the only other time it was this far extended above the 200-day moving average was right here when it was hitting resistance. And I'm not suggesting that we're going to see some exact repeat by any stretch, but this is a great place to enter a short yield long bond trade. And so the trade, again, is the same thing as it would have been here to do the same thing. So I just wanted to share whether it's the 150 or 200, just two different examples, but how we can apply the power of the pattern and some other filters that we work on in the background. Sentiment perspective, this is the sentiment on the 30-year bond, and kind of hard to believe, but right now it's about 0 bulls. Not a misprint. That's where it is, and you can see not too many times. This is looking back from Sentiment Trader over the past decade. Obviously, this is an excess pessimism category. Yields are obviously, this is what they've done here is made this the long bond instead of, because yields ought to be going the other way, so they put the bond up here, but you can see that here was sentiment was high this summer when we shorted bonds and where it was. You can see here when it was testing channel support how there weren't many bond bulls. And so to me this is very fun to see in a short time swings, to see this kind of a sentiment shift. A lot of opportunities presented themselves in July. I believe tons of opportunities, if not more, presenting themselves now. This is a busy 4-pack, and I think we're going to see this again, and I apologize for this. I'm going to go right past this one. You guys remind me somehow, if because I want to talk about this in pieces. But as we just saw a chart. I saw this on the web. This is from Charlie Bigelow and Pension Partners, and Charlie had this great chart, and he showed that this is the 5-year forward inflation expectations rate. So keep in mind, everybody, this is a sentiment perspective. Where do you think inflation will be long-term going out? And so this summer, when yields were at a low and bonds were at a high, you can see that even this, from this sentiment perspective, it looks like a yield chart. And so right now, expectations are testing potentially, if you can chart something like this, double resistance at 1. And so this is a big test to see how far confidence can go. But you can see that inflation expectations, we've experienced deflation in many commodities over the last time period. So I find it just very interesting that we can look at an interest rate chart and a expectation chart, and they look just the same as far as hitting channel resistance. I did a chart over the weekend, and I just wanted to kind of, you may have seen it on the blog, but it got some attention, but I just kind of wanted to talk about it for a minute, that its attention in some ways was unfounded. But thanks, Todd, premium members saw this on Bloomberg TV where they were mentioning some of our work, and this was yesterday, and we were very honored by it, and then Zero Hedge picked it up. But one of the things that I just kind of want to bring up about it is each of the people that picked it up and shared this, it was also on Bloomberg Radio, it's all about how bearish of the chart pattern that this is. And when I produced the chart, I didn't say that it was anything, I'm not defending anything, but I didn't go out and say this was incredibly bearish. All I did was, this is a chart of, we'll just look at it. This was what was published this weekend on the blog. I took the S&P and divided it by TLT to look at us, to create, a stock bond ratio, and you can see that the ratio hit a certain level up here in 2007, and as stocks started rolling over and bonds started doing well, you can see the ratio went the other way, and so this would appear at that time that was an extreme, and then this was an extreme in 2009, but you see it somewhat parallels, this influence obviously by the S&P. And if you look when this ratio, came down in here to 2011, that was a pretty good time to buy stocks. And then, here's 2000, early 15 last year, when for you long-term customers, that we've been talking about the 2150 level in the S&P 500. Well, as this ratio peaked, that was when the S&P was hitting that Fibonacci 2150 800-pound gorilla, at that time. So it is back, the ratio, at 2007 levels. I don't think that means a lot other than it is at extremes from a stock bond ratio, and this is the big move where we long yields and shorted bonds, and we're long the financials, and we got this pop right in here. But now this is testing from, if we didn't know what this is or its relevance, we would just say there is, it's at a high, it's been choppy for what, a couple of years, and it's testing triple resistance, with one of the resistance points being its 2007 high. Now a lot of the media just took it, well, boy, this is really bad, you got a repeat of 2009. Hey, that's way above my pay grade, folks. I'm not going there, I'm not saying that, but I do find from a valuation perspective this is something I did it because I think it's something to pay attention to. And this would be a place, in other words, that if bonds started to rally and stocks struggled at support, that's where this chart could end up meaning something. Right now, it's really intriguing, just at a lofty level. One of the things that I'm a student of Sir John Templeton, and one of the things, I was lucky in the late 90s that Sir John made the case that stocks in the late 90s, his essential paraphrase was, we're in the late 90s, Chris, I think at best this market will be flat 15 years from now. I had done a lot of buy and holding going into that, and that got my attention. But this is one of the things that he talked about then, and so I just wanted to kind of share an update in respect to Sir John. But this is kind of a mixture of some fundamentals and chart analysis both. But this is from Jesse Fielder. This was on his, I caught this on his Twitter page. And this is household financial assets divided essentially relative to disposable income. And so this is in the 1950s, and I know there's not much of a reference point, but I just kind of want you to remember the year 1968. And the reason I bring that up, if any of you are historians, roughly from the mid-60s, does anybody you recollect, if you looked on a Dow or S&P chart, where was the Dow in the mid-60s, and then where was it in the early 80s? And so we'll come back and answer that, but this is, you can see that this indicator at that time was the highest that it had ever been in this 14-year stretch of data. And then you'll see what happens after that, and you see that from a valuation perspective, it continued then to fall into the early 80s. And the reason I was asking that question is the Dow was at 1,000 here, and the Dow was at 1,000 here. Now, which was a better time to purchase if you were combining price and fundamental, some type of fundamental analysis, which this is nothing more than a sentiment indicator. It's just how much money does society have in these assets, and then how scared are they? And this chart's meaningful to me because in the January of 1980, I graduated from college. The Dow was at 1,000. I didn't know much. I was approached by a company that said, Chris, we're the oldest mutual insurance company in America. We've got our own investment. We're the only, we're the first ones to have investments, and we're going to start something called financial planning. And of course, I'd never heard of the word. I'm still in college. It was just not much of a word to anybody. I had my VW energy crisis had happened. I went and got my securities license. I got my insurance license. And boy, were people not interested in stocks. And why was that? It's because, well, it hadn't went anywhere for 15 years. Plus, they could go down to the local bank and get a CD for 15% plus a toaster. But from a sentiment perspective, as we could all look back, what a great time in 1980 to buy stocks and bonds. We were just embarking on what a great 20-year run in stocks and a 30-year run in bonds right from this point of valuation. So now we'll continue to go on, and we'll just watch this thing progress over the years to current. So this was where Sir John talked to me in the late 90s and said, Chris, due to several things, and this was one of them, things have gotten a little out of hand, and so that you better find ways to risk manage your book of business. So at that time, I'd been in financial planning for about 18 years because it's in the late 90s. So I just want you to be aware of something like this. This does not, hey, this ratio is the highest in all of history. But that does not mean the market is at a high itself or going to top. But what it does mean to me is that when we see valuations reach these levels, it pays to know what? Risk management techniques, knowing your stock stops, knowing where the exit door is, if you're prone to it, how you could take advantage in inverse positions. But folks, this is not about, I'm not putting on any bearish hat or anything. This is just to me, it's fascinating that this is an emotional graph created by actual, hard numbers. And then, goofy old Chris, he probably can't leave this chart alone, right? So what if, we just talked about earlier, we look for tops by first looking for bottoms, looking for parallel channels, and so we can see that this bottomed in the early 80s and took off, and this had been, 2003 after the 9/11 attack, financial crisis low. So there's somewhat of a trend here. So what if we create a parallel line to that and bring it in? So you can see maybe we have an emotional channel up here that could be important from a power of the pattern perspective that's based upon fundamentals, but is really just an emotional chart because it shows how cocky people are or they aren't and how much they own of financial assets. So, out of respect to Sir John, I always want to show these type of things, even though we're going to make our decisions based upon price patterns and emotions. This is an emotional chart that really is important to me, and thanks for letting me bore you here for a couple minutes on it, but this is important, friends. And this is important to me because of an example of this is the S&P 500. We're at all-time highs right now, but one of the things that I still, we have to keep in mind, this is I created this by going into these bottoms here, creating a double, and look, if you lay it on top of 2000, look where it came into play this past year. It's in play right now. A parallel channel to that laid on 2007. Mark these bottoms through this past year, and this is a monthly chart. Look at that huge bullish wick right on this parallel channel of this whole piece. Not only is this an important level from just a channeling perspective, but you've seen this before, long-term members, we've talked about it now for a year and a half, but this is the 1987 crash low. This is the 2009 crash low, and I just applied Fibonacci to that, and the 423 Fibonacci extension comes in at the 2150 level right up here. So this is still in a form, there's no doubt the market's in an uptrend. We're not fighting that whatsoever with our positions or mentally or any of that. But this is some resistance that I think we should respect. We just saw fundamental, wise, the financial asset percentage in this. So got to respect this. Breakout would be great because get all kind of new life to this. But right now we've got to be cautious up here. And I think then the thing that intrigues me is now let's look at the flip side. This is the 30-year yield going back to the early 2000s. And you can see this overall, I wanted to look at bottoms first, so we created this top line, did a parallel of it, and you can see how the bottoms came in. So when you start seeing connect the dots here, you see the more of the actual channels, everyone, that's taking place. This is the median line, it's a parallel of the top and bottom, and then you can see this resistance line coming in. So this is where we longed yields or shorted bonds. And so right now as a premium member, that I've been nibbling going back now to the long side in bonds, and I'm trying to do it as tight as I can up here, and you'll notice, it's up against dual resistance and yields, and the relative momentum is one of the most overvalued levels in the last almost 15 years, right up here, in the upper right. So it's interesting that stocks could potentially be at resistance, and yields are also at resistance, or bonds could be at support. So now we're going to look at a combination. We saw this chart just a little bit ago to where we applied the Fibonacci to these 87 and 2009, and that we know that it's at the top of the channel. Now what you're going to see here is the yield on the 10-year note, but I turned the yield upside down, and not to trick you any, but to take the yield and have it look like bonds. So this is a chart of bonds overlaid with stocks. This is as far back that I could get yields to go to the early 90s. So we're talking over 20 years. And again, folks, this is a monthly chart. So there's a lot of data here. I've just smoothed it out to be monthly. So you'll notice that as stocks are testing long-term channel resistance, bonds are also testing long-term support. And so when we look at some different extremes, we can see the stocks peaked here, and there was a low in bonds here. Stocks were at a low, and bonds were at a high. Stocks were at a high, and bonds were at a low. We see a low here in stocks and a high in bond prices. So we do see some of that traditional non-correlation, seesaw back and forth action between these two. And so this is something that really, from a power of the pattern perspective, I find it very exciting to see these types of setups, because this is where some really fun things can happen, and you can see some even more resistance came in to, you would want to look at this as bond support. Now obviously, folks, I mean, sometime this bond trend is going to break. And right now, I think banks would love it if it does. So I'm going to be completely open-minded to this. I'm not going to, I don't spend any time thinking about it as a 30-year, bond bull market over with, because you know how long it'd really take to know that? I mean, interest rates could go up to 4 or 5%, 6 or 7, and people could still say, still in a bond bull market because we're way still off prices in 1980. So I'm not going to waste any time. You won't hear me talking about that very much, going forward. But a really fascinating price test of support and resistance in non-correlated assets right now. Very rare. Busy chart, and I apologize, but I want to just get through a lot of different pieces. But this is what I want to call my interest rate sensitive 4-pack that we share, with you each week. This is real estate, IYR in the upper left. This is TLT in the upper right. This is utilities, XLU in the lower left. And so all these three that we first covered are essentially negatively impacted by interest rates. And the case in financials in the lower right, they're impacted by some positive interest rates. So the bottom line is some long-term key channel tests are in play. IYR is testing triple support with momentum deeply oversold. XLU is doing the same, triple support test, momentum's oversold. Bonds the same. And financials are, this is XLF, is testing a couple of resistance levels with momentum about as high as we've seen in quite a few years. Probably, I mean, just 3 or 4, excuse me, but it is obviously in that upper level. So these are, from a trend purchase or a trend perspective, you want to be a purchaser. These are great entry points for all 3 of these, and I said this in last week's sectors report that you know your risk propensity more than I wouldn't encourage just whole hog buying a whole bunch of highly correlated positions all at the same time, but pick out some of your favorites in this area and be a buyer with tight stops, because if these long-term trends break, then we've got a real different animal on our hands. It'll be an opportunistic animal, but it would probably reflect going back to shorting bonds. Could be really positive ripple effects that we'll talk about still in the bank stocks. Some things in the banking area could just be getting started. So really key, one of the biggest, to me this is the biggest test in these interest-sensitive pieces in a minimal of at least 6 years. The big test on the bigger perspective, this is the 10-year German Bund, and we continue to share this weekly. Obviously, this is, to me, one of the cleanest chart patterns on the planet of any asset. This is about 35 years in length, and you can see up here in the upper right, it's testing dual support. And so what you see coming in the lower right of the screen is nothing more, everyone, than just this upper chunk of information, just the last few years. This is just the last 2 years. But you can see how the German Bund is testing dual support, or real close to it, of this 35-year channel. So if we would see TLT break support, IYR, XLU break support, the German Bund break support, AGG, that's the aggregate ETF, MUB, which is the tax exempt, they're all on the same, hitting similar support levels right now. So you want to buy on support, but then understand that if these things break For years it's been what? Buy the dips and sell the rallies. So if we would see these long-term trend changes, then you would be doing the opposite. And so we'd be selling any rally in bonds and buying the inverse on any dips. So here's another one talking about just how rare this is. This is your inflation expectation chart that each of you can do, but this is taking the TIP, which is the inflation protected treasury, and dividing it by TLT. We shorted bonds here and long yields. You can see now even this ratio is testing dual resistance after a very rare and sharp move, and so we are taking a shot at longing bonds right here at this point. Obviously, if this would break out, it would send a more inflationary message. And as all of you know, as premium members, and we'll cover it later on, we have several plays that are based upon commodities, heading higher at this time that are starting to make us some money. So we'll cover those, shortly. So we're going to make a switch now from the interest rate field, and we're going to look for a minute at some currencies and then what some positive solutions and plays could come off of that. But thanks to Ryan Dietrich, he sent me this magazine cover from last week from The Economist. Ryan knew that we were considering that the dollar could be maybe topping, and this really stuck out. And so The Economist, we've all heard of the magazine cover thing to do the opposite, and it's fun, it's quirky, so magazine cover does not have a 100% batting record, but you'll see kind of why this intrigues me of that coming out. So before we move on to charts of the dollar, this is just to kind of update you on the sentiment of, whoops, I'll go back, sorry about that everyone, but just to give you some perspective, dollar bulls right now are just short of around the 70% level. You can see just recently it was almost up to 80, and you can see that oftentimes when dollar gets crowded trade, a lot of bulls, it gets closer to a high. This was the 100 level in 2015 when there was a lot of bulls, and so it took quite a while to work some of those off, and you see the dollar just traded sideways. But I wanted to update you that there's not a terribly crowded trade, but the crowded trade, if there was one, is to the bullish side at about 70% bulls. So the reason this is really interesting to me, and in the interest of time, I just can't build all these charts live for you, but this is the US dollar weekly over the last 15 years. So we'll start at the bottom if we want to see if we could find resistance. So I took these two emotional points, created a support line, did a parallel to it, and looked and then put it on this optimistic peak, and lo and behold, look how the high of last year, or the dollar peaked right at that line, and here it's right at the top of this channel line again. And this is one of the more rare situations that I've seen, but this is two different Fibonacci, a retracement and an extension coming together at the same price. So I took the low here in 2008 and the high, and then applied Fibonacci to 161 level, and so that's the blue fib lines. And then we took the high in 2001, 2, and the low in 2008, applied Fibonacci, and so this rally that we've seen since the 2008 low has retraced 61% of this entire decline. So we have potential triple resistance, or we're at the top of the long-term channel with a couple of fibs coming into play. And then this box here is a blow-up of the blue shade, and what gets me, this is a weekly chart, so 2 weeks ago, right at the blue dotted lines are the different fib levels, there is a potential doji star reversal in the US dollar right up against resistance and the two fib levels. So this is where we established a short position in the US dollar. The ETF is UDN, or a similar play could be owning FXE, which would be longing the euro. So it would get almost the same punch out of either play. But at this time, we've shorted the dollar right up here, and then I just put a stop right above this because it would be a triple breakout if it took place. So we made a little bit of money on that. But again, everyone, trying to get this right is critical to me, but it's not about the trade of owning the dollar or shorting it. It's the ripple effects, because as we all know, the standard deviation in currencies, you know, if the US dollar would move 10%, it's a huge move, but it's the other things that if the dollar would move 10%, it's other things that could move 20, 30, 40, or 50 that interest me the most. But I want to start here. This is the dog that wags the tail. So again, but I want to say this, the trend still in the dollar is up. And so if we would break out, that would be very bullish for the US dollar. The magazine cover would be right, and commodities would probably get kicked in the backside. You know, so this is a critical level, but you know, right now, when you look at our positions, you know, we're betting the dollar will go down and we're long commodities. So if the dollar would break out, we would have several trades with tight stops that would be closed out, and then we would take the opposite side of the trade if that's what takes place. But keep price point for the dollar. Here's the trade. This is UDN. You can see it just looks almost the flip side opposite. I went back as far as I could when UDN was created. So this in the lower left is just give you an idea, is 2010, 2009 right in there. But again, UDN is the opposite. It's in a long-term falling channel. Created it here at the start, paralleled that, laid it, and you can see where it's come into play. Two different other potential support lines, a bullish falling wedge came in, so we bought UDN down here. Again, we're up a little bit on the trade, but I'm not saying anything is proven. So far I like what I see, but far, far from proven that the dollar has reversed course and UDN is heading higher. Here's just, you know, earlier I mentioned you could be shorting the dollar or longing the euro, so I just kind of wanted to let you look at what the euro looked like as the dollar has been in a long-term uptrend. Here's the flip side, the long-term downtrend in the euro. The dollar's chopped sideways for the last year. In an uptrend, you can see that the euro's chopped sideways in a down trend. But the euro right here, that's where we bought UDN or shorted the dollar, or in other words, long the euro right here. You can see that little bit of a bounce has taken place, but you know that again, 1 week's action doesn't prove a trend. You know, as with the dollar, I said a minute ago, the trend on the US dollar is still up, and we'd say just the exact opposite on the euro. The trend is still down, and obviously if the euro would break dual support here, then the trade would be go back to owning UUP, which would be long the dollar, and you'd want to get out of the commodity trades. But right now we're betting on a rally in the euro with a stop just below it. One of the things I wanted to update on the crude oil, and again, the inverse head and shoulders pattern that we've been discussing since July is not proven, but now we're at a really fun price point. But before we talk about that, I just kind of want to step back. You know, let's take a breath and go way back and look at this. This is crude over, you know, the last 30 years. And so I started just building this chart because I was wanting this. I started building this looking for a bottom for all of you earlier this year. So we built the top channel line, and we see a throw over here, which doesn't, you know, you always have to question something like that. But there is I first heard it with Elliott Wave that there are throwovers where it sucked in the last bulls here, and then haha, and then it fell from what 150, you know, down to 30 or something like that. And so this was really just got the last people in. But I paralleled this top of this rising channel for 30 years, and I applied it on the bottom, and you see that it lined up to the lows earlier this year. But what's most intrigues me is this line coming through here, which is nothing more than a parallel of either the top or the bottom. But you'll notice that, you know, this was an emotional, pessimistic bottom here. You know, it wasn't very influential here. You see the market come up here, and then once it hit it and came back, and it really rocketed higher. And this is the key point. You notice that it rocketed to the top of this channel. The low here in 2009 came right in on line with that. Then here was the first test in the collapse last year in crude oil. Went above it and then sliced through, came back and kissed the underside. And so in my opinion, that has a chance to form the left shoulder. Came down here and hit the bottom. Oops, I apologize. Hit the bottom of this channel. Rallied back up in July is where we said if this is an inverse, it needed to fall to form the right shoulder. It has, and now it's chopped higher. So this is a dual test, the neckline and this channel line coming in, that if it would break above this, it would be super bullish. And obviously if it broke above it, it doesn't mean that all of a sudden, because I have 100 up here, just 100 becomes automatic. But this would free this up from a channel perspective to try to work its way, higher. So this is a really critical level, and this is not about whether crude and stocks correlate going forward. This is about the crude market and its ripple effect plays, which we own, such as the energy stocks in XLE or the oils in OIH that we own. We've also discussed XOP that's out there. So to me, this is a big deal for what I think is the most important commodity, on the planet. So we saw that the channel line could come into play at 100, and this is why it's a big deal to me from a measured move perspective. If totally unproven still, I mean, so far things have fallen into place fairly textbook. We said, we said right in here that it needed to decline, and it did down here to this potential right shoulder. You can see the right shoulder was just a fraction above the left shoulder if this is to be. Even if it's not an inverse head and shoulders, I don't have it drawn here, but you can imagine or connect these lower lines. This is a bullish ascending triangle that if it breaks through this resistance, which two-thirds of the time this pattern is bullish, if it would break above this line, you could take a measured move, from here to here. But what I'm most intrigued about is the measured move if crude oil is really pulling. It's taken, what, a year or more to form an inverse head and shoulders. If it's true, the measured move would say you take the distance from the head to the neckline and then you lay that, so that's 1. 2 is nothing more than a duplication of 1 laid on the neckline. The neckline has not been taken out. This is serious resistance that's being tested right now from the prior chart on channels plus this plus the neckline. But this is the measure move that would call, if you could break above it, you'd take this same distance of 1, multiply it to 2, and that's up about to the 100 level. So I find it intriguing. It's just most likely right now a coincidence. I hope that all of us can look back in the future. It's not about why it would go to $100 if it does, but if it would, I hope that we could all, look back a good period of time from now and say, I'm glad we recognized that pattern. I'm glad we played it and played its ripple effects. So a lot of opportunities here, folks, if this is true. I don't care about having an egg on my face. If this doesn't, come true, it's not about that I own this or anything. This is me trying my darndest to read the emotional levels of the world. People leave footprints in the sand, and I'm just trying to read them to my best ability, for you guys. So this is the oil sector 4-pack that we've been sharing, with you. This is crude oil in the upper left, XOP in the lower left, XLE in the upper right, and OIH. We own both of these, XLE and OIH. All of these have the potential of either inverse head and shoulders or pennant patterns with breakouts to the upside. So the chart that we looked at earlier at crude, this is still testing the neckline. This is where these plays would not want to see a failure. In crude oil, you'd want to see, obviously, a breakout. I have a bias because of owning to the long side, but our stops, I've continued to pull them up on these positions that if we would see a failure here with crude, because again, folks, this is not about any pie in the sky. This is all about risk management. That, I love questions of, Chris, what's your target on the upside? But very humbly, the first target is we're trying to get out of the chute and own these things with the least risk applied. And so right now, I do like what I see, but the biggest issue is just risk management and watching crude here at this neckline. If it breaks out to the upside and you happen to be long energy stocks, I think you'll be very well rewarded for the trade. This would be one trade that if crude oil really went up, we're going to talk about it in the future, what we call searching for clusters. And so this is Weatherford International, the symbol's WFT. It's an energy stock that has been pounded. You can see up here it was trading roughly at the $50 level and then down to $5. So we got a 90% decline, but there's an intriguing cluster of support right in down in here that's being worked on, with this last piece being a potential bullish falling wedge. So this would be a play that could be a very high beta play to the upside that you would want to, if we see more breakouts and positive strength in the oil complex, WFT could sure have some potential. If you play something like this, the standard deviation is high. You would want to expand, your stops. This doesn't, look like, much, but if this is $5 and that's down to $4, that's a big percent. 3.5, that's even a bigger percent. So I shared this chart, before, and that's a chance of a nice bullish wick down here. But it's not about what's happened to this date. It's about this pattern. If crude oil and energy would do well, this could be a puppy that I wouldn't put tons into by any stretch, but it could really pay off as far as a high standard deviation play to the upside. And obviously, if oil fails and WFT would break down here and just fail at this cluster of support, be a heck of a short, everyone. Even at $5, falling a big percent, you could make some money. So to me, I favor this trade to the upside, and I'm going to follow with this if it breaks out to the upside in conjunction with following crude oil doing well. So I know we've been talking about crude oil as commodities, but I wanted to take a moment and just look at the overall commodity index. This is the Thomson Reuters commodity index that we've been sharing for years. 2 years ago in July of 2014, we shared right here that it looked like the right shoulder of the mother of all Head and Shoulders topping patterns. And so then we saw a breakdown at the right shoulder and it fell hard. But to me, this has a chance of being obviously support, has a chance of being the neckline of this monster pattern. So even if it is the neckline, and if this read is still correct, it's a topping pattern, you have to be very cautious then on rallies because this is still in a long-term downtrend. So this is why where the commodity index is right now is really, really critical when we think about that the dollar could be peaking. What if commodities could be pulling a major reversal off of this long-term? When you think of emotions, this emotion was a high in commodities, talking about cocky, in 1980, and then it just let the air out of commodities for 20 years, everyone. And then you think about, on the flip side, the emotional highs, then this was an 11-year upward push. So commodities have been down 5 years in a row. Never happened in the history of commodities, even in the Depression, what we've just seen. So this is some serious selling pressure, but it could be some really serious opportunity if we could see some dollar weakness and overall commodity breakout of this channel and fib level. This is a monthly chart. I wanted to show you monthly momentum, just how oversold that it was just a few months ago. It's rarely been this oversold on a monthly basis. Historically, when it has, you've been a lot closer to a low than a high. What we're going to go through now, and this is the same chart again. I just took a couple of things off, but I just kind of wanted to show you that this could be an inverse Head and Shoulders in the overall CRB right at that support line, and here's its testing dual resistance, which is the form of a neckline. So if we would see dollar weakness, it's not mandated, but if we'd see what the ideal situation would be was UUP strength, which would be dollar strength, followed by UUP weakness is what you'd want to look for commodities, and you'd want to look for FXA, which is the Aussie dollar strength, and a Canadian dollar FXC strength. And so if we saw FXA, FXC, and commodity strength with a crude oil breakout here, it'd be really positive. So the risk on trade that we've seen has been positive in the energy complex and commodities, to me, would gain a whole new series of aha moments for people to buy these. So really fun and exciting levels. And that's why I'm excited about is I think the standard deviation of this last year, which has been really low and boring to many, I think we're going to see some of that come to an end. And that excites me from trading it. You can see over the last couple of months, there's that adage that 80% of your gains in a year come in 20% of your time. And you can see we started off the year in a big decline and we were shorting it there. You can see that we can pick up here towards the end of the year that you can really do well when you get movement even in short periods. So another chart that I find really intriguing is, speaking of commodities, is natty gas. Now, this is a monthly chart going back to the early 90s. So I want to show you kind of how I started to build this. I came down here and looked at these. Again, this is monthly closing prices. So I tied these closes in, and then I created a parallel, laid it on these emotional highs, lined up here, and this is a current chart where we are right now. So I wanted to show you how we started off with this, building this, and this is monthly closes. Now the next chart is the same chart, but all I did was I converted it to high-low close, so you can see any potential reversal patterns. So you can see that when natty gas tried to get up here in 2013, this was a big move from 5 to what, 7? It's almost a 50% move right here. But boy, on a monthly basis, is that one of the? It's kind of like if you somebody gave you a salute with a finger. That is a heck of a bearish reversal right here. And you can see what it led to. I mean, from $5 down here at 5, 4, 3, 2, below $2 after that reversal. So we're back at the top of that channel. Really key test that I'm going to show you an overlay. Let's just go ahead and go to it. This is an overlay. The red is crude oil. The dark is natty gas. And you can see oftentimes it correlated pretty well from 1999 to 2008. Sometimes if these bigger spikes was natty, got ahead of itself up here. So whenever you spot something like that, the trade's long natty, short natty, long crude, when you see this type of spread or fish mouth pattern taking place. Right in here, then the trade, and we did this for our customers, was, you look at up here with this type of thing is short crude, long natty. But what intrigues me the most is just that both of these have been hammered hard for a few years, and over the last year and a half could be forming reversal, long-term reversal patterns, potentially being head and shoulders. So a lot of some opportunity. We just saw that natty gas was up against a monthly channel resistance. But if it would take it out, this would be an ancillary play, which would be natty gas. And of course, no pun intended, the ETF that probably stinks the most in the world is UNG, which is the natty gas ETF. But if we would see a quality breakout, I just, buyer beware. That obviously if natty gas is flat or it goes down, you'd lose, and you could lose big. But if these patterns would happen to be correct, even old stinker UNG would have an opportunity. But here's one that I think could even be a much greater opportunity in that field, which is Cheniere Energy, which is a play on liquefied natural gas. And you can see that Cheniere, let's see, folks, was trading about $84, and this was in 2015, to a decline of around $20 earlier this year. So there's a pretty good 2/3 haircut plus. But the key thing to me is we've seen some rally in LNG. That's the symbol for Cheniere, everyone, this year. But now it's testing. This is a weekly chart, testing resistance right here. So if we would see a breakout in crude, this would be one of those ripple effects that could do really well. This thing got way overdone. I don't think there's, even when you think of owning Apple or Google from early stages, I apologize, but I mean, if you kind of think about this, and we could go back further, not on this chart right now, but this was $8 to 84. I mean, I think that's something like 1,000% up. And so it went up a bunch, gave back a ton, but it just shows that there's opportunity. So that, again, this would be a high beta play. And I'm not trying to show risk here, folks, when I mention high beta. You know, when you think back of, you know, we bought American banks and European banks prior to the election just because of the power of the pattern, and then if we're right, we don't have to risk a bunch, but if we're right, it can pay off very handsomely. And so it's not about aggressive plays, it's about opportunistic risk-reward plays. And so if crude would, the energy complex would keep going up, and the inverse head and shoulders was a successful read, this could be a play. I'd want to own this LNG on a breakout. So kind of in the commodities areas, we've talked about that this is the Swiss franc and another 30,000-foot long-term view. We're going back to 1993, a quarter of a century. We were fortunate that the power of the pattern led us to suggest in September of 2011, where we suggested that gold would be at best flat to down for years to come. This was because of the power of the pattern suggestion of where the franc was and where sentiment was at the time after 11 years up. But the bottom line is there's some very nice parallel channels taking place here. But when the franc bottomed in 2001 here and embarked on a rally, gold and silver, this was their heyday. They screamed, and gold didn't have one down year for a decade as this franc, you know, went higher. Once the franc reversed, now gold and silver have been down each year since 2011. So the thing that intrigues me the most is a test of dual support. You'll notice that the franc hit this channel, came down here, and then tried to get back above it, and then fell, tried again. This was this took place the day that one of our grandson in Kansas was born, where they came out overnight, the Swiss government, and this was an immediate just pop. You can see even though they tried to influence the franc, it did nothing more than ran up here and created a bearish wick, and the same pattern then continued. So even despite government intervention or influence, they couldn't change the long-term trend. But what intrigues me is once it got back inside this middle one, it's really just traded time. I mean, it's down from 120 to $1, so don't get me wrong, that's a 20% decline. But it went from the top of the channel to the bottom. And I find that really intriguing because this is a dual support test and what that could mean for other plays. If the franc would find support here and rally, you know, that would be beautiful news to the long side of gold and silver. So big test in franc. And then the next piece is I want to show you is nobody likes the franc. Nobody likes franc. This is the Swiss franc sentiment over the last 16 years from Sentiment Trader. And of all the currencies right now, the sentiment on the franc, this is the least liked currency in the world, which maybe has one of the most influences in a positive correlation to metals. So this is a big test that when the rally in metals started in the early 2000s, you can see how pessimistic people were on the franc. So we're testing a long-term support line in the franc, plus this horizontal line, and with few bulls. So the uncrowded trade here would be long the franc, which would be FXF, and then if that trade works, it would have a really positive influence on the metals complex. And so speaking of the metals, earlier we shared how we do rate of change as filters. This was a 20-week performance, and you can see that GDX had this great rally earlier this year, and then now it's declined 32%, in other words, given back almost a fib number, a third of this entire rally in 20 weeks, and of the times that it has fallen this hard in a 20-week time period, GDX has been closer to a tradable low than a high, even while it was in this bear market, because you can see it's in a downtrend, but when it got this far oversold, you can see that there was a rally. There was another one here, and these can be deceiving because if that's $20 to 30, that's a 50% gain. Right here is 17 to 22, another big percentage gain. So I find this from a filter perspective, very encouraging, especially if the franc would find support. One of the things, so now we want to take a look at high beta plays as if, the gold mining stocks aren't high beta enough. But I want to share with you with maybe one of the ultimates. If the dollar would turn weak, the euro strong, franc strong, FXA strong, this would be something that could really pay off. But this is the Silver Miners ETF, SIL, divided by GDX, creating a ratio. And so when this is going up, SIL is outpacing GDX. And so this is earlier in the year, and we know that GDX had a heck of a rally. I mean, it's largest 6-month rally in the history of miners. But look at this, SIL outperformed GDX by 50% to the upside. And so I just want to share this with you that if we get a breakout in SIL, which here's its chart pattern, you can see how it's been compressed just like GDX, that there's a quad support cluster down here in play, and if it would break out to the upside and some of these other positive things take place, SIL could scream higher, scream higher. So getting close to the end, thanks for putting up with me, but one of the positions that we owned prior to the election was just the belief in the European possible financials. And I know that had to be a fingernail on a chalkboard that, before all of this, a lot of people wondered if things were going to be a bug on a windshield, much less why would you own banks, and then why in the heck in the world would you own, of all places, European banks. And again, this was just a non-crowded trade of a place that had been hit hard, but EUFN has been pushing up of late. This is a weekly chart, so this is this week's action. So you see a nice pop out of it's been confined in falling channel 1 for the last couple of years. It was as high as $27 down to 15, so close to a 50% haircut. So it's gotten up to the top of this channel, and each time so far it's paid to sell at resistance. We did sell a little bit of the holding and brought the stops up, but it's a nice pop this week, and now we see dual resistance coming into play. And as I sent this out to premium members earlier today, if we'd see a breakout at 3, if you don't own EUFN, you'll probably want to own some, and could really attract a lot of buyers after getting hit really hard for quite a long period of time. So one of the ultimate plays in fingernails on a chalkboard and out of favor, we'd shared this a little bit one other time, but it is Deutsche Bank. This chart, folks, this at the top was 140, and down here was 14. So that's a 90% haircut. But DB was up like 700 basis points today, pushing it up to this falling resistance line. EUFN that we own, I don't know this for sure, but I wouldn't be surprised if DB is not, or I'd be surprised if DB is not inside EUFN, but it doesn't have to be. But when we saw a strong rally in DB today, it carried over to other European banks. But this would be another example that if DB would break out at 1, one of the higher beta plays, if this is for sure a good play, being in the financial sector, which I believe that it is, we own it, this could really get some legs right here. So I wanted to get you aware of where DB is and what its potential could be if the interest rate theme, if you think about if all those interest rate charts, aside from sentiment, of all those interest rate charts that are up against resistance, if they take those out, we now have a 20 and 30-year channel change on our hands. And we've all heard that oftentimes the banks could respond favorably to higher rates. The argument's been they've been struggling because of lower rates, and so this is what helped lead us into this trade, was to when we were making money in shorting bonds and seeing higher interest rates, that gave us confidence to go long banks in America and in Europe. And if it breaks out, here, trend channel changes on, or trend channels break on interest rates could be a lot of fun, you know, in the banking sector. So this would be one of the ultimate out of favor plays in the banking sector would be DB. So a couple other emotional kind of wrapping up here. This is XIV, which is inverse volatility. As the market has rallied this year, fear has fallen, so that's pushed XIV high. So this is the fear ratio, which, as we just say up here at the top, anytime that the XIV is closer to, you know, essentially the 1 level or higher, it's a great place to be longing XIV, and XIV is historically closer to a low than a high, and when it's down here, XIV is closer to a high than a low. So it's kind of intriguing where you see XIV right now up here at potential resistance as the ratio is at this low point. So another really critical setup on something that's highly important and it's highly influenced by emotion. So I went longer than normal today. If you're still with me, thanks for hanging in there. It just went longer just because of the exciting opportunities that are at hand. And I hope you had, you know, just as much fun as I've had of late, and I can't say thank you enough, regardless of language. We're very humbled by your membership. Thank you for all the new members and the referrals that we've gotten. Rick and I really appreciate it. So all the best to everyone, and look forward to seeing you, communicating with you daily, and seeing you next month at our next webinar.